Hey everyone, welcome back to the channel, your number one source for income-oriented investing. Very special guest today. I'm here with Carl Chong, head of ETFs at Ninepoint. How are you, Carl?
How are you doing, Adriano? Nice to see you
Good.
and nice to see you again.
Yeah, we were talking earlier. We're both from Montreal, so we have that in common. It was pretty cool to catch up on that. But today we're going to talk about the Nine Points new covered call ETFs. But since this is the first time, someone from Nine Points on the channel, I want the audience to know really who you are, Carl. So tell me a little bit about yourself, a little bit of background, and maybe a little bit of background on Nine Point as well.
I'm happy to, and nice to meet your audience as well. As I mentioned just in our previous conversation here, I've been in the ETF business for nearly, say, let's getting close to 20 years. It doesn't look like it, right? I've gotten that comment a few times, but I did start in the industry close to 2009, 2010. I helped launch some of Canada's first products, first to mover products. I remember back then there were fewer than 100 ETFs in Canada. And now there's clearly, we talked about over 1,500 and you take a look at the statistics. And so I helped launch some of the Canada's first to market products. Our team had launched the first gold bullion, the first US dividend product. I worked on the first laddered bond suite products that were fairly popular and helped grow awareness. So through all that growth, and my focus has always been the same, to really bring innovation that solves investor problems, higher income, tax efficiency, risk adjustment. And so that lends to the Ninepoint story. Uh, Ninepoint will be relatively new to a lot of your viewers. Ninepoint manages about $7 billion and is one of Canada's largest asset managers. So our specialty has always been in the commodities and alternative space. Think things like energy and real assets. Some of your viewers might be familiar with NNRG. That's managed by a portfolio manager, Eric Nuttall, that I know has been quite popular in the social media
Pretty
channels.
popular, right? I've seen him on BNN a lot. He's always talking about, he's very bullish on energy, I believe, right?
Energy is certain, energy and natural gas, but energy is certainly his
Mm-hmm.
passion. And that was our first entry into the covered call space. NNRGI is the income oriented version of NNRG, and that may have caught in some radars. But these are the areas that have generally, when you're thinking of alts and commodities, these are the areas that give investors diversification
Yeah.
beyond traditional stocks and bonds. So they're especially, we think, valuable during periods of market volatility. And so early days when we launched the firm, this is back in 2017, it was a buyout from Sprott Asset Management. We called our philosophy alt thinking. So that means we're not just launching cookie cutter products or just plain vanilla beta products. We're focusing, as I mentioned, solving on real investor needs, whether it's generating reliable income, we're trying to improve after tax returns. We're offering simple structures that investors can actually use. And that'll lead really well, Adriano, to HighShares, which is a perfect example of that approach. And I'm happy to get into more details there.
Yeah, for sure. So you guys are launching a bunch of these high shares. So these are single stock covered call ETFs, of course. So these are your first covered call ETFs. So why did you guys decide to launch them right now?
Really good question. We saw clear white space in the Canadian single stock covered call market, and we were the first to file for these products. Going back to my history, what has been a key indicator of success in the Canadian ETF industry has been to either be first mover or
Mm-hmm.
you add value over and above existing strategies. And we've seen that doesn't always particularly work, but in our industry, it has truly led to some successful ideas. So across the country, investors were telling our salespeople, our executives that, I want Canadian blue chip stocks, but I wish they just really paid me a little bit more every month. Think of like an RBC that's generating a 3% dividend yield. Maybe that's just not enough, right? And that's your business right now, Adriano, focuses on these higher yielder products. So with higher rates and inflation, cost
Mm-hmm.
of living, some of the things we were just talking about, this has become a priority for Canadian investors. Now, when you take a look at some of the early wave single stock products that have been very, very popular, you think single stock covered calls, I should say,
Yeah.
most of them are focused on US technology names. You know, the very popular names such
Yeah,
as
of course.
MicroStrategy and others, yes.
Yeah,
Um,
Nvidia,
so that
etc.
left the gap. Oh, sorry to cut you off there, but
No, no,
that
it's
really
okay.
left a gap for Canadians who wanted higher income from Canadian companies they already own and trust. And so that's why we took a look at iShares and tried to build out that lineup.
Yeah, it's funny you should mention that because I even started my journey with having those Canadian dividend stocks and wanting more, and that's what led me to, the covered call ETFs, et cetera, et cetera. So that makes complete sense. I'm sure other Canadians are on that path as well that need more than, 3, 4%. So let's investigate and let's look at the ones that you've launched. So you guys have launched, it seems here, 10 single names, I believe, and an all-in-one, correct?
Yeah,
So you
100%
have
ECHI. Yes.
yeah. So let's go through them real quick. So you have TD, Suncor, Shopify, Royal Bank, Enbridge, CNR, Canadian Natural, Chemical, BCE, Barrick, and then you have your all-in-one. So tell me a little bit about the stock selection. What made you decide on these particular stocks here?
No, next great question here. So when we built HighShares, we had a certain way of thinking about this. We have relationships with some discount brokerages to
Hmm.
understand some of their data on some of the most widely held stocks. So what we did is that we took a look and started with some of the most iconic companies in Canada, the ones that have built this economy. Like you mentioned, RBC, Enbridge, Barrick Gold, Shopify, railway. So when you think about that, they're not just random picks. They represent Canada's economic engines. And you can classify it into different sectors. So banks like RBC and TD, gold with Barrick, uranium with Chemical. They're really household names. And I'm sure you would agree, they're trusted and held by a lot of Canadians already. So that was really important. They also, on the second point, really important for a covered call strategy, as you know, they traded deep in liquid options markets, which is
Yeah.
absolutely critical. Sorry, you're going to say?
Yeah, I was good. I was just agreeing with you, and I'm just curious now. I know a lot of these tickers are actually listed in the US as well. Correct me if I'm wrong there,
Oh,
right?
that's a really good point. And that so about six of them actually on the individual
Okay.
stock side are dual listed, and so that offers a deeper liquid options market
Hmm.
in order to source creations and redemptions and dealing with investor activities. So we have a lot of runway there that I think is really going to be critical for sustaining a covered call strategy.
Perfect. Let's talk about what everyone always wants to know at the beginning and what I think everyone should investigate, right? Fees and strategy. So this is where I'm going to have a lot of questions. So let's just go through. I'm looking at the TD one, but I believe the strategy, the fees, the same for pretty much all of them here. So looks like you have 0% management fee. This is a promotion till end of Feb of next year, and then it's going to 29 basis points, right? So
Mhm.
that's a pretty low management fee. A little bit more on that later. And you're going to have 25% leverage to boost yield. This is a very common thing on covered calls in Canada, covered call ETFs. So this 25% leverage, this is classic leverage, right? You're borrowing the money, 25% of the NAV. Okay.
100%. Each ETF will use, and we might not use all 25%, but
Okay.
that's called modest leverage, where we're looking at ranges 20, around 20% there. But when you can think of leverage, as you know, if you've educated your audience there, is $100 invested, giving you roughly $125 of exposure. What that does is just nudge the yield a bit higher and it doesn't go overboard. I think
Yeah.
it's a reasonable way of thinking about it.
It's a good it's a sweet spot,
Sweet
right? Because
spot.
like yeah,
Exactly.
I agree with that. That's personally my favorite. Everyone knows, like I always say, that's my favorite style of fund. It's a covered call ETF that doesn't do more than 50% coverage with the 25% leverage to really narrow down the performance gap that you're typically sacrificing with a covered call strategy. So speaking of covered call strategy, portfolio coverage, I see here, up to 50% of the NAV. So you're not writing on more than 50% of the portfolio, or is it at 50%? Is it between 33 and 50? What can you tell me about the coverage, first of all?
No, and that's a good and really important point. So we can write by the prospectus up to 50% of its shares.
Okay.
The reality of what we're trying to do here, it's going to be a little bit higher than I know some of our competitors, where you are going to write in the 40% range, give or take 5% on the underlying securities. So that harvest, as you know, the option premiums for some of the steady cash flow, but it leaves at least half of the position uncovered for upside participation. So we're going to be writing slightly out of the money and with
That was going to
laddered
be my next
strikes.
question.
I got to jump to there. Yeah, we're with some laddered strikes and maturities. So we're not just pinned to one expiry date. That gives us some real flexibility on how to manage changing market conditions.
Okay, so this is very important. So cover call strategy, no more than 50% coverage, but you guys seem to be comfortable near the 40% range. And in terms of moneyness, slightly out of the money. Is this also something that's active? And well, maybe we'll do at the money this month. Maybe we'll go a little bit more out of the money this month. Is this an active approach, would you say, or is this more of a passive cover call approach? My guess is active.
No, 100% active. And that's going to be one of the differentiators, I think, for us as well. We have lots of options expertise. As I mentioned at the beginning, alternatives is where we've uh, tried to build a business on in Canada. And that allows us to use that expertise we have. The portfolio manager, and sometime maybe he might come on the show as well. He had overseen a $26 billion derivatives portfolio for IMCO. So there's lots of expertise on that front, and we'll take advantage of that expertise as healed. As one example, if
Mhm.
if if Shopify is one of the stocks there, has a significant drop in price, then we might not write as much for that month to allow what we think is potential upside potential and grab more of the upside in that front. So we'll be able to do this in a more active manner. And I think that's a great value add for investors.
Okay. Yeah, I always prefer an active approach when it comes to it. It seems to me if I look at all the fund providers, those who do passive versus active, the active ones tend to do better. I think it makes sense, especially on a single stock. Like you said, if something happens to Shopify or anything, it drops like a brick. Well,
Right.
there's a higher chance that it's going to rebound. So maybe, okay, less covered calls, so we could capture more of that upside. Makes complete sense. Now, I'm very curious about your management fees because obviously you have two major competitors in Canada, of course, where my audience knows who they are, and they also have single stock cover call ETFs at the 40 basis point. You guys are zero, then going to 29. So how are you able to do it at 29? I'm curious about that.
Great. When we designed HighShares, and I just started with Ninepoint in May, but this was one of the ideas I certainly thought about with the group on how we take advantage of this single stock covered call area. And one of the big decisions, of course, was the pricing. We made the call you mentioned earlier to waive the management fees until February 2026.
Hmm.
And then we set them at just 29 basis points, 0.29% after that. So that makes us in this category of single stock covered call ETFs the cost leader. Now,
Yeah.
the ETF business. Now, getting into the nuts and bolts of the ETF business, it is really about scale. So by setting the fees this low, we know it means that each ETF will need to reach a higher break even on the AUM compared to the higher cost products. But going back to the business case, we're very confident on the total addressable market for the Canadian income ETF market. It's large enough to support that. And the way we see it is that lower costs are going to be a structural advantage for investors. Every basis point you don't pay in fees is one more basis point of income your investors will keep. So, in an income focused strategy, that's going to be, and that'll make a huge difference, as you know, over time. So, just going to the strategy side, we really wanted to differentiate from existing offerings by leading with a low cost structure, and running a single stock ETF with an option overlay is very, very efficient. And we felt it's important to pass along those efficiencies.
Sounds good. Sounds good. I just want to talk very quickly about your all-in-one. I'm a big fan of all-in-ones. because you get instant diversification, less the babysit, et cetera, et cetera. So you guys are launching ECHI or have already launched it. This is your all-in-one. So this is going to hold the 10. Was it 9 or 10? I think it was 10, right?
It's 10. It's 10.
10. This is going to hold the 10 single share ETFs. Is it equal weight?
No, and I think that could be a differentiator. As I mentioned, I had spoken to Jordan a little bit earlier on Saturday, and it's the all-in-one option.
Yeah.
So to your point, Adriano, it holds all of them,
Yeah.
but it's going to be we didn't equally weight it; we yield weighted it. So that
Oh,
means the
interesting.
higher yielding names
Yeah.
naturally get a bit more weight,
Okay.
and so that's a blended portfolio leaning toward income while staying diversified. Now we capped each of the stocks though, that it can be the max weight of up to 15%.
Oh,
So
okay.
you could imagine Shopify and Cameco would be 80% of the portfolio, just giving the distributions we announced yesterday. So basically, what you have here then is that we'll cap Shopify, we'll cap Cameco at 15% to
Okay.
allow for broader diversification.
Okay, so you're gonna have a little bit more towards those higher yielders, but max 15%. It's not like you're gonna do, like you said, Shopify and Cameco 80% of the portfolio. No. So 15% max, but all 10 names are gonna be in there, skew a little bit towards the higher yielding ones.
Yeah, exactly.
Okay, and this is basically is gonna hold the other Ninepoint products, and as we know in Canada, there's no double management fee, so we could for essentially say that by the end of Feb or whenever those management fee for lack of a better words, this also is gonna have a 29 basis point management fee. You're not paying 29 plus 29, right? 29 and that's it.
No double dipping.
No double dipping,
0%
exactly.
managed fee at the top fund level, and then it's the underlying fees, like you said.
Sounds good. Sounds good. So is it possible that I know you're not allowed talking about future products, but are you guys considering or thinking about launching further Canadian names or even getting into the US name game as well? What do you think
And
about that?
I love that type of feedback. These conversations are so helpful for fund manufacturers as well. If there is a demand for the US tech names at a lower cost, then we're certainly interested in talking to everyone about that and planning through. But so when it comes to covered call products in Canada, absolutely. So the high shares framework, the Ninepoint high shares framework is very, very scalable. The
Hmm.
universe is infinite almost in Canada and the US. And you didn't even mention Europe and some of the other areas. I don't want to give our competitors ideas there, but any expansion will be very thoughtful and disciplined. However, we're not here to create Me Too launches. As I mentioned, yeah, first mover adding value over and above existing in some way. So every ETF that we'll launch in this suite will meet three criteria.
Hmm.
One will be it will be widely held, strong investor interest. There'll be deep and liquid options markets, and then lastly, based on my initial comments, we're looking for real investor demand, something that helps democratize or maybe fractionalize access to well-known securities. And we're thinking we're doing that with our high shares, but we're looking at additional Canadian leaders and potentially global names. So don't be surprised, Adriano, that we might be coming out with filings in the next couple of weeks or months on other names that we think could resonate in Canada.
At this point, nothing really surprises me in the cover call space. I mean, it's just been I've never
Yeah,
been so busy in my life. Let me put it that way.
that's great.
Okay, cool. So also, I know we can't talk about yields, especially within the first year, but have the first distributions been declared for any of these yet? I'm actually didn't see that on the website or anything like that.
I'm glad you mentioned that. Yeah, maybe we could post it afterwards on the link after. But yes, we did announce our distributions targets for
All the
the end of September to be paid out October 9th. So I encourage you and your viewers to go take a look at. I think you'll be, comparing to some of the other products in the marketplace, very pleased with some of the yields that we're producing.
All right, everyone. We found the data here. So you guys have, here it is on the screen. You guys have launched or have, sorry, declared your anticipated monthly distributions per share. So we can't discuss yield, but my audience, I'm sure they could do grade two math. And these are monthly distribution rates. I forgot to ask you, so the distributions are going to be monthly. Is that correct?
They are. The distributions will start off monthly. That's the industry standard
Yeah.
and what investors are most familiar with. Monthly really just fits in nicely with Canadians' budgets of bills, mortgage payments, etc. But we did talk a little bit here about bi-weekly payments. That sounds very attractive. In practice, a little bit more complex, but we're seeing some of the providers offer that, so we're willing to have that conversation and take feedback on that as well.
Yeah, I think it's all the rage now. The more frequent distributions, the better. I mean, monthly is good. You know, I do my stuff monthly as well. Some people like semi-monthly or even weekly. That's in the US they have weekly. So, yeah, there you have it. So I'm just curious. You had previously anticipated, then you have new anticipated, and some of them went up. What made you decide to bump some of these up, like Chemical and Barrick and Shopify, I believe, etc.
So we're able to be very flexible and increase distributions, names like you mentioned, Shopify, Chemical, really because of two things. One is the strength of the underlying stocks. And then secondly, the way our high share structure really captures that strength. So when a stock like Shopify rallies, Shopify just reported earnings. It was up like 21% in one day, a fantastic quarter. The option premiums from our covered call strategy also rise as well. So it was able to really give us more income to pass through to the end investors. Similarly, when you look at Chemicals volatility, it's been an amazing performer. Strong sector momentum means the options trade at a higher premium. So that really translates into higher cash flow investors. So on top of that, you mentioned there the leverage, the modest use of leverage really magnifies the
Yeah.
exposure to these companies. So it shows the flexibility really we're taking here on a month-to-month basis.
Okay, and you started the initial well, the initial stock prices or NAVs all started at $10 per share for all of them, I believe, even the all-in-one, right?
Even the all-in-one ECHI, they all start at $10. So
Okay.
we did that very intentionally as well. Just let's see here the background on how that kind of worked out on our side. But you know, $10, we're trying to fractionalize the shares so it gives investors a lower cost basis to start from. And we just made it easier for dripping and watching your unit count compound over time. I think there's like a psychological benefit of holding like
Yeah,
100 shares, 200 shares, 500 shares, etc.
for sure, for sure. And just going back on the distribution, so are these distributions, do you expect variations? Because a lot of my audience, they're typically, they want that consistent cash flow. It's very important for them because they're in retirement. So can your monthly distributions fluctuate? Well, and if so, are they going to fluctuate a lot, or how are you managing the distribution payouts?
No, and that's an important point. We are going to pay out what the portfolio generates on the option premium. I mean, when you take a look at the distributions, they're going to be classified in three different areas. You'll have the dividends from the underlying stocks, and that's really
Yeah.
one of the difference. With Canada and the US, these are high
Yes.
dividend payers on some of these. And so you have that. You have the option premium on the actual the options classifies capital gains, and that's on the portfolio. And then there's a portion of return on capital, and
Yeah.
we'll try to smooth that out over time. So no, you won't see tremendous volatility. We, based on our modeling and our back testing, have came out quite confidently that we can sustain these type of distributions over time,
Okay.
just based on historical data.
Okay, so you expect fairly consistent distributions, but as we know, these distributions are based on call premiums, which are based on volatility. There is that dividend component. So investors can expect some sort of variation up or down on some of these names in terms of the distribution. Would that be fair to say? But not a
That'd be
crazy
fair to
amount.
say. It's just you won't have wild swings. As
Exactly.
you
Okay.
mentioned, investors want consistent income, and we've thought a lot about that.
Perfect. That's exactly what I wanted to hear. And yeah, we might as well talk about taxes because this is a question I get all the time, right? Well, first of all, if you hold these in a TFSA, RSP, sheltered account, it doesn't really matter. But in a non-registered, like you said, right, the only three sources of income you'll ever get from these is eligible dividends, except Shopify because it doesn't have a dividend. So like Bell and Telus and a lot of these stocks have a dividend. So a portion of that income actually is that dividend. And call option premiums in Canada, it's either capital gains or ROC. So those are the only three. You're not going to get foreign income or regular income, correct? You only get a combination of those three tax classifications, if you will.
Right. And so you mentioned the US side. The US side has dividends that has that withholding tax of like
Yeah,
15%. So you don't get clear flow through. The distributions for high shares were really designed to be tax efficient. They're not just going to be simple dividends, like I said, which are actually treated very favorably, as you know, in Canada. They're grossed up. Because of that covered call strategy, a large portion of that cash flow is going to come from the option premiums, and they're generally taxed as capital gains rather than income. Of course, talk to your accountant. But what that will mean for the end investor is often they're getting a lower effective tax rate compared to a traditional fund that are offering more
yeah,
on the
that
interest income side.
like bonds and things like that with
That's right.
regular income. Yeah, my audience knows very well. Discuss this all the time. So let's get into some more a little bit harder questions. I mean,
Yeah.
you definitely could take it, I'm sure. What's gonna make you look? You have a lot of competition. Okay, let's not sugarcoat it in Canada. What's gonna more established players in the cover call space? I'm Ninepoint is well established, but newer to the cover call game. So what's gonna make you stand out to other fund managers in Canada? What's gonna give you the edge, do you think?
I mean, first, let's say competition is a good thing. I think we all benefit. It's the reason I've been in this industry is that we want to offer more choice to the end investor. And that's a good thing, just to start with. So it validates really the demand we're seeing from Canadian investors who want more income focused solutions. But where Ninepoint will stand apart, I think, is going to be on three areas. And these are going to be proven over time. First, it's explicit the fees. We
Yeah.
talked about we waived the management fees. They're going to be priced at 29 basis points. That's 28% less than other products in the category. And so that's going to be the lowest cost, lowest in Canada, a single stock covered call ETF. And over time, fees matter, especially in income strategies where every extra dollar counts. So we want to make sure Canadians not just get the innovative solutions, but at a cost that leaves more for room for income potentially in their portfolios. The second is the strategy side. So many covered call ETFs very can be very formulaic, maybe more rules based. At Ninepoint, as we talked about, we're going to be very dynamic and manager driven. That means
Mhm.
we're going to adapt the option writing. We're going to how much we write, when we write, at what strikes based on market conditions. So we see greater upside ahead. We might pull back, as I mentioned, on the covered call coverage to capture more growth. So I think the flexibility is going to be crucial in today's markets. It's very uncertain, and you get a lot of feedback from our client base. That's what they say, where dispersion amongst the winners and losers are going to be high. So you want an active tilt on that. And then lastly, the firm itself. Ninepoint isn't just an income generating shop, as we established. We're one of Canada's leading alt managers with deep expertise across energy and real assets, credit strategies. So I think a broader risk lens gives us more of a comprehensive perspective than just firms that focus narrowly on one product set. And that allows us to build income solutions with a stronger appreciation for risk and sustainability, and then more for investor outcomes, I should say, on that. So I think combine the three, just to summarize: fee leadership, dynamic strategy, firm depth. We think that's a genuine differentiation in the marketplace.
Good. Okay. Yeah. I mean, that's pretty much all the questions I have. Now, I did reach out to members, and they know I was going to talk to you guys soon, and some of them or many of them have referenced me to this article about three Nine-Point funds that have recently suspended distributions. Now, these are not covered call ETFs. These are other funds, and from the date here, this is a little over a year ago. So obviously, you already mentioned, you already know that investors invest in these types of products for a consistent monthly distribution. right? So maybe investors, people that see this kind of thing are a bit scared. And yeah, what if they, suspend on the covered call side as well? You want to just discuss what that's all about? I didn't have time to read the article, honestly, but maybe you could just give or maybe reassure my audience that, is what that was about.
I'm happy to provide an overview there, Adriano. It's really important here to separate two different parts of our business. Ninepoint manages both private credit funds, exchange traded funds, mutual funds, and they serve different investors with different structures. So in private credit, just for your viewers, if they've ever invested in it, or never invested in it, I should say, you're investing in loans and liquid assets that don't trade on a daily exchange. So when
Hmm.
redemptions rise or market conditions tighten, the responsible thing to do sometimes is to slow withdrawals and reinvest distributions rather than just pay them in cash. So that article you referenced, that's called gating. And so while that sounds dramatic, it's actually a standard safeguard in the private market world. The goal is always to protect investors and preserve the integrity of the portfolio. So rather than allowing the early redeemers to disadvantage those who remain, what we did exactly, and you mentioned a year ago, we made it prudent and a temporary decision to remove distributions as to new units, ensuring that we had more fairness and long-term stability. HighShares, on the other hand, HighShares ETFs is a completely different platform. These are liquid exchange traded funds traded on the TSX. Investors can buy and sell at any time during market hours. No gates, no redemption
Hmm.
suspensions, no restrictions. HighShares was really built with Canadians to generate high monthly income on blue chip Canadian companies. So
Yeah.
RBC, Enbridge, and others. So that's just a simple one ticker solution with full daily liquidity and transparency.
Yeah. Those funds, correct me if I'm wrong, those were closed-end funds. They weren't even ETFs, right?
100%
Okay,
different
yeah, completely
structure.
different. You know what? I've actually seen similar stuff on closed-end funds before. So it's completely different ball game, right? ETFs, cover call ETFs. Okay, I think that should reassure people, my audience that no, that it has nothing to do with this. And I'm now a final question, because I got this question in my mind. Are you guys, in terms of distribution policy, are you giving out everything you earn to the investor in terms of distribution, or are you maybe holding, let's say, 1% back? I know of a Canadian cover call manager that likes to hold a little bit back to just in terms of safety or whatever. Are you guys giving out everything you earn away? Not more than you earn, I'm sure, but uh, what's the policy there?
Really good point. Our policy is to distribute essentially all the income generated by the high share strategy. This is the mandate of the products themselves. But to really that includes that you mentioned the dividends from the
Yeah.
underlying stocks as well as the option premiums through the covered call strategy. The only amounts we will retain, so on a portfolio manager side, is to cover funds operating expenses, which are, you could tell there
Yeah, of
it's going to
course.
be quite modest. But so what investors will see is that their distribution is the full cash flow the strategy is designed to produce.
Makes sense. Perfect. Okay, and you'll never give out more than what you take in, which is technically called bad rock. So we're not going to
Bad rock.
expect that. Okay.
Yes. And you mentioned in your previous videos, is the total return is what I feel is the best benchmark for investors to take a look at these products.
Always. It's the ultimate truth of everything is what I say, right? So,
100%.
Carl, you've been a great sport. I really appreciate your time. Maybe the audience doesn't know this, but you said I'll take any question, no whole, no restrictions or anything like that, which to me is always a good sign. Not everyone agrees to that when I have them on. So thank you very much, and hope to have you again soon to discuss maybe some more future products as well at Ninepoint, especially the cover call ones, which is what my channel specializes in. So thanks again.
Amazing. Nice to meet you all.